International Monetary Fund approves $88.3 million emergency financing support to Malawi. In South Africa's inflation rose to 7.6% in October. Zambia's central bank holds key interest rate for the fourth consecutive month this year. Hello and welcome to the program. I'm Will Ibong. First things first, let's check in on the markets. We begin with Africa, where sentiments were positive at intraday. We see the Nigerian NGX was up 0.066%. South Africa's GSC was also up almost 1%. If we flip over to the north of Africa, we see the Egypt's index was up 0.62% at intraday, while Kenya closed Tuesday's trading session down 1.04%. Now to the Middle East, where sentiments were also mostly positive at intraday. The Abu Dhabi index was up 1.31%. Dubai's index was down, however, 0.12%. We still see within the region, Saudi Arabia is up there, 0.32%, while Qatar also up 0.58%. In Europe now, we see Germany's central bank is preparing for the prospects of winter blackouts driven by the energy crisis. Our DW correspondent Robert joins me from Berlin to discuss this and how the government is going to try and mitigate this. Rob, Germany's central bank has sought to reassure Germans over the prospect of winter blackout. What has the Bundesbank been saying about this?
Well, the central bank has really tried to allay any concerns over how it would cope in the extraordinary event of Germany losing power this winter by saying that it would be able to continue supplying Germans with cash even without electricity. Now, the Bundesbank's executive board says that though it doesn't actually expect widespread power cuts, it is preparing for the possibility. It says that across its 31 branches around Germany, it has enough cash to last for 5 days and emergency backup power supplies that could keep things moving for at least 72 hours. Now, you may be wondering why the Bundesbank has thought it necessary to make this statement, and that's because history has shown that in times of crisis, Germans turn to coins and banknotes as a stable material way to ensure they can continue to buy what they need. And the Bundesbank's comments also come shortly after reports that Germany's financial authorities are preparing emergency plans, possibly including limits on cash withdrawals. Now, the bank's board says it doesn't believe there would be a need to restrict how much money people can take out, and financial institutions are also thought to be preparing contingency plans to mobilise temporary emergency cash points should some German regions find themselves in a prolonged period without power.
So how realistic is the prospect of Germany trying to struggle to keep the lights on this winter?
Well, remember that Germany's energy supply is being squeezed. Germany was heavily reliant on Russian gas to meet its power needs before Russia invaded Ukraine. And since then, we've seen a combination of both Moscow reducing supplies to Germany and Germany taking its own steps to wean itself off Russian energy. That's led to a months-long scramble by Berlin to ensure its gas storage facilities are sufficiently full to get through the winter, something that the government says is now the case. But the spectre of energy shortages does still loom here. We've heard from the head of Germany's energy network regulator on this. His message, though, was don't panic. The German government says that the prospect of prolonged widespread power outages this winter is extremely low, and the network regulator says that though localised power cuts are possible, they would be only localised. There'd be advance notice, and they wouldn't last for any longer than 4 hours. So Germans are getting a lot of reassurance that this winter, at least, the lights will stay on.
We don't want to see a Black Christmas, Rob. But what sort of day are we expecting for Europe's markets today?
Well, we're going to be keeping an eye out for whether European markets continue the gains seen in Asia and their own gains from yesterday. Two major issues that are dictating the mood are the oil market and COVID cases in China. Oil stocks rallied on Tuesday on rising crude prices after reports that the OPEC Plus oil producing cartel was planning to push on with its controversial decision to cut output. Meanwhile, in China, record numbers of COVID cases there are seeing further restrictions on Chinese businesses, and that obviously has clear potential knock-on effects for the rest of the world, not least Europe, which relies heavily on exports from China. Also looming over investors here is uncertainty over the next move on Eurozone interest rates. There are mixed messages coming from central bankers, with some at the ECB, the European Central Bank, saying it might be time to open the door to smaller rates increases than the 75 basis points that we've seen with the last two hikes.
Thanks, Rob Watts, DW correspondent there. It's always good to have updates from you. And now over to the UK, where rail passengers are facing more and more disruption unless, according to the rail union, a settlement is reached in the long-running dispute over jobs, pay and conditions. Juliana is in London with the latest updates on this. Juliana, UK Transport Secretary Mark Harper is urging the RMT boss to meet on Thursday to call off the rail strikes over the festive period. Do you think Mike Lynch will budge, as he says the Christmas strikes don't make him a Grinch?
Good afternoon, Will. Yes, he has said it doesn't make him a Grinch, and that's because, of course, there's been another week and another announcement of a round of industrial action for already beleaguered commuters who have had so many train cancellations throughout the year. And these new set of 8 walkouts are going to impact people at a time when they are going to be very, very busy. We know that lots of people that live in London do tend to go back up to the country to see their family during the Christmas period, and then of course we've got new workers that will be starting jobs in the January. So these 8 days are going to cause panic, which is why transport bosses are really hoping that they can get some sort of settlement with the RMT and ASLEF union before these strikes kick off. And I think it was pretty right that you spelled out what's been going on. This is about work, job and conditions and pay. Lots of members of these unions, in fact 40,000 members, just not really happy with how they've been treated ever since we've come out of the pandemic. We know that because of the pandemic and because so many people were working from home, the pattern of working has shifted. And because of that, transport bosses say they need to also shift the way their workers are going to work. And I believe that union members are just really worried about how this is going to set up how they work in the future. And also as well, we are living through high inflation times. Inflation is at a fresh 41-year high. They want to negotiate a proper a pay package with an uplift of at least 8% minimum. So we'll just have to wait and see, as we always say, but it's a very, very bitter dispute. And unfortunately for rail bosses, even though most people in this country do like and respect people that are willing to, down their tools and fight for something, because we're all going through the same situation at the moment, I think they're starting to lose the sympathy that they once had with the British public.
I do hope this situation is resolved on time, because we don't want holidaymakers to get stuck or not have to travel to visit family, especially those that have been probably cut off from family for a long time. And this is when they want to travel and then they don't have transportation, especially cheap rail transportation, which is very vital at this moment. We just look at other sectors that are seeing the downtime in UK right now. The private sector just recorded another reduction in business activity in November. That's a 4th month of decline, Juliana. This recession is just deepening, isn't it?
It is biting. It does appear as if we're definitely heading into a deep, long recession, as quoted by Andrew Bailey, the governor of the Bank of England. This could be the longest recession that we've ever had on record. And I think that the data, the flash data we got from S&P's global index looking at the private sector, so this is services, manufacturing, construction, it has shown that it has dipped slightly. Well, there was an uptick. So in I believe October, we were at 48.3. In November, we are now at 48.4. So there has been a slight uptick, but bearing in mind anything above 50 that's recorded does show that there has been a contraction. And I think it kind of points to what we had from the OECD, which is a very influential Paris-based think tank, saying that, look, you know, the UK is in trouble. If you look at all of the other G7 nations, so that's France, Canada, Germany, the USA, Japan, they've also gone through what we've all gone through, which is the pandemic, the war in Ukraine, supply chain issues, but they've managed to show an uplift of about 2.26% of their GDP. Britain is the only country, G7 nation, that's showing a decline. And those were some of the questions that Prime Minister Rishi Sunak was getting from Sir Keir Starmer at the recently held PMQs, because what is happening to this country? And we are seeing that it is causing strikers, workers to down tools and to go on industrial action. We're also seeing that a lot of people really not happy with just the cost of living crisis and the fact that it is so expensive just to buy the basics in this country. The Chancellor thinks that, you know, the autumn statement and showing the international community that we do have financial credibility will help get some investment in. But of course, we're talking much later, and really people need the assistance now, which is why they're not spending. And that was reflected in the flash data we received this morning.
We do hope it doesn't affect or it doesn't creep into the markets. How are they doing at intraday?
Not bad, actually. In fact, it seems as if the markets, well, certainly the UK blue chip index has kind of shrugged off that downbeat data. I presume it's probably priced in because all we seem to be getting is gloomy data from the UK at the moment. The commodity market's really helping lift the FTSE at intraday. The all share is up 0.23%. The FTSE 100, that's up by 0.25%. And the FTSE 250, the domestic market, that's down by 0.08%. In the currencies market, the British pound is currently trading up against the US dollar by 0.33%, also trading up against the euro by 0.28%. And the British pound is trading up against the Japanese yen by 0.56% at intraday, Will.
Thanks so much, Juliana. It's good to have you back.
Yeah, it's nice to be back. Thank you.
Now, shares in Asia Pacific are mixed today after US stocks rose overnight and New Zealand central banks delivered a 75 basis point hike, the biggest rate hike ever in the central bank's history. Singapore's latest inflation data showed some easing in October on an annualized basis. The NZX 50 index in New Zealand closed down 0.85% at 11,323.8 points. The S&P ASX 200 closed up 0.7%, despite the Reserve Bank of Australia Governor Philip Lowe on Tuesday hinting at more rate hikes ahead. South Korea's Kospi closed up 0.53%. To stand at 2,418 points, while the Kosdaq ended 1.84%. Japanese markets are closed for a public holiday. Now we'll flip over to the U.S., where stocks futures were marginally higher today as investors looked ahead to Federal Reserve meeting minutes for clues into the pace of future interest rate hikes. Dow Jones Industrial Average futures added 36 points. S&P 500 futures were marginally higher, while Nasdaq 100 futures rose 0.08%. Now let's get yesterday's close from our correspondent, Maria Bird.
The U.S. stock market rose on Tuesday, as all three major indices gained more than 1%. The Dow Jones rose by 1.18%, the S&P 500 rose by 1.36%, and the heavy tech Nasdaq rose by 1.36%. It is clear that investors were not concerned about the tightening of COVID restrictions in China. That has not yet or may not impact the U.S. economy. It is also clear that investors are watching and hopeful that inflation will continue to decrease, as it is expected that interest rate hikes that were expected for the end of the year may not come as rapid as once previously stated. This could have major impact as the U.S. is in the midst of holiday shopping season, so many consumers may continue to spend, and this may have an impact on the U.S. stock market that will bring more gains in the marketplace. The U.S. is also watching to see what will happen with oil prices, as gasoline prices are beginning to reduce in the U.S., despite the fact that OPEC has stated that they will continue to cut the production of oil. Only time will tell as to if this will have a major impact on the U.S. stock market.
Welcome back. In negotiations that went down last weekend at the COP27 meeting in Egypt, countries reached a historic decision to establish and operationalize the Loss and Damage Fund, particularly for nations most vulnerable to the climate crisis. Komea Jigbo, Vice President Investment, Africa Finance Corporation, AFC, joins me to discuss how this decision impacts Africa and the implications for Africa's energy transition. It's good to have you here, Komea.
Thank you. It's a pleasure to be here.
Now, this whole thing has been historic because Africa has been at the brunt of climate change. We've been suffering. Possibly we emit less carbon than other developed countries. Well, what are the COP finally reached the loss and damage deal? This is good news. However, what is the real cost for the countries that emit more carbon?
So I think this is a fantastic question, and I actually would like to break it down into two pieces. So first, what is the actual deal that was reached? And then we can get to what is the real cost, right, for countries that are emitting more. So when we take a step back, even though it was announced that a deal was reached, when we dig into it, the metrics, the fundamentals are actually yet to be agreed. So we know a transition committee needs to be set up. The nominations are yet to happen. The committee will be set up by December of this year. Secondly, their first meeting is not until March next year. And then they have a whole year, i.e. up until COP28 next year, to actually present a proposal to the UNFCCC to actually, vote, discuss, and actually agree on. So when we talk about a loss and damage deal being reached, the substance and the form is still yet to be determined. But I think what we can say in summary is a lot of the rich countries, as the economists put it, have finally sort of decided to acknowledge that they probably do need to compensate the less emitting countries. Now, when we talk about what is the real cost, because the fundamentals of the deal are actually yet to be set up, we don't know how much is going to be contributed. We don't know the funding instruments. We don't know who's going to be eligible. We don't know how much commitments are going to go in there. But in order to understand or determine what the cost should be, I think it's important to understand what is the cost of loss and damage. So if we start first thinking about the NDCs and the commitments African countries have made, it's estimated that we need to invest $300 billion on an annual basis up until the year 2030. However, to date, only about 30 billion has been invested. So there's already a significant gap in terms of the commitment for climate financing, mitigation, and adaptation. And then when you bring it home and think about the context in Nigeria and the floods that we've been having, the World Bank Group estimated that about $17 billion was lost due to loss and damage from floods in the year 2012 alone. That's in 2012. And we all experience and appreciate the impact of the floods this year. So I think if we take a step back, right, yes, the deal has been reached in principle. The substance and the form is yet to be determined. When we talk about what is the real cost for countries emitting more carbon, we don't know what it is yet, but we do have an indicator of what it should be.
This is quite interesting to know and quite vague at the moment. We would like more clarity on that. You mentioned that $300 billion is needed annually to be reached by 2030. And then right now, we're currently at 30 billion. And Nigeria is already, from the flooding, we've lost about $17 billion. So how do you think we can bridge this gap, this funding gap that we have, especially for Africa that is trying to transit, to cleaner energy, cleaner fuels? How do you think we can, mitigate, Africa can mitigate this? And what are the financial implications since we already lost so much?
So there's a lot in there to unpack. I think if we first start with the financial implications of the loss and damage deal, unfortunately, like I just mentioned, the substance and form is still yet to be determined. So we don't really know the implications for Africa. Not yet. We know the cost of loss and damage, but we don't know if this new mechanism is actually going to, be a drop in the bucket or be a substantive opportunity to really transform things. Then when we talk about, financing for mitigation and climate change and adaptation, so many people have very possibly forgotten that just a little over 10 years ago, the Green Climate Fund was set up. And it was set up specifically, just like the loss and damage deal was created. It was set up specifically to provide financing to mitigate against climate change, but not just to mitigate, also for adaptation. Its priority was on Africa, on least developed countries and SIDS. $10 billion was committed. Over $11 billion has been actually committed by the Green Climate Fund to date. So over the $10 billion commitment that they have. They're currently in a replenishment cycle trying to access more funding, but we need to take advantage of the opportunities that are being presented to us. We need to ensure that the seat we have at the table is substantive, it is pragmatic, and it's providing expedient solutions to the continent. There's a lot of institutions that are currently unable to access this funding, and we need to find a way to ensure that we can do that. The Africa Finance Corporation, the organization within which I work, is one of the first institutions, African institutions, that was accredited by the Green Climate Fund. We are able to access this financing and create our own innovative financing solutions. We're also working on the ICRF, which is focused on climate resilience and adaptation. So like we are doing, many other institutions need to start to think about innovative financing solutions to mitigate and adapt climate change. And finally, when we talk about imminent energy transition, it really pains me to hear people talk about the energy transition on the continent. When you're talking about transition, it means you have something and you're moving from one form of energy to another. We're talking about a continent where more than 50% of the people do not have access to power. So what exactly are we transitioning from or to, right? I think we need to change the narrative and be a little bit more focused on ensuring that we are getting sustainable access to power. Sustainable access means base load. It doesn't just mean renewables or wind or solar. We need to utilize the abundant resources on the continent to ensure we are able to successfully develop and facilitate and catalyze economic development on the continent. So that's sort of, in summary, I would say the seat at the table we have, is substantive, and we really need to be a driving force for pragmatic change.
Thanks so much, Komi Ajegbo. We do hope that these, what you've mentioned, what you've mentioned will shape conversations for future, especially for COP28 that's coming up next year. Future conversations on climate change will be shaped by these factors that you've mentioned. We do hope African governments key into this and other institutions key into this to be able to, pave the way for a greener Africa. Thank you so much, Komi Ajegbo, for coming on the program.
Thank you.
And now we move on to other stories where the IMF has approved today disbursement of $88.327 million to Malawi under the new fund shock window of the Rapid Credit Facility. Malawi is the first low-income country to make use of the food shock window since it was adopted by the Executive Board last month. At the same time, the Executive Board discussed the new Staff Monitored Program, SMP, for Malawi, which was approved by the management of the IMF on November. Now, South Africa's inflation rate rose to 7.6% in October from 7.5% in September, staying above the upper limit of the central bank's target range of between 3% and 6%, and that's according to Statistics South Africa. The agency says inflation remained highly driven by rising transport and food prices. It has that transport prices posted an annual increase of 17.1%, with fuel prices up 30.1%. And now we move on to Zambia, where the country has held its key lending rates as the Central Bank of Zambia has held its key lending rates at 9% for the fourth time in a row this year, citing slowing inflationary pressure in Africa's second largest copper and cobalt producer. The central bank says Zambia's recovering currency, propelled by improved food production, has helped the economy to slow down inflation. And that's it on Business Incorporated. I'm Willie Bong. Thanks for watching. Bye for now.